whatever you invest in, try to understand it. So for instance, if crypto was your thing, understand it deeply. And if you do, then, and if you're willing to take a bet on it, spend up to, I would say, up to 20% of your portfolio taking the bets that you make you happy taking after studying them well.
Okay, great, everyone. Welcome back to Chills with TFC. Not easy to get this gentleman on set. You want to introduce yourself for everybody that don't know you yet because you don't always come on media.
Hi, I'm Ashok. I'm retired. I used to work in the financial
I love
services industry.
how retired is your first identity marker.
It is, right? Yeah. People usually ask, what do you do?
Yeah,
my answer is nothing. It's very liberating to be able to say that.
Yeah. But before that, what were you doing before that?
So I used to work with one of the local sovereign wealth funds, GIC. I worked with GIC for 22 years in their private equity business, and now I'm not.
Wow. How did you end up in the business?
It's funny. It seems to be, private equity seems to be one of the hottest places where young people want to be these days.
I think it still is.
It is.
Right, yeah.
But when I joined the industry in 1990 in India, there was exactly one company doing it. Nobody wanted to join them. I wasn't the most fabulous student. For various reasons, I kind of stumbled into the industry and it grew. Yeah, so dumb luck, maybe. That's how I got in.
Why did you ended up in this industry to begin with? If at that point in time it was so unsexy.
So I think all of us, or many of us, need to earn a living. And that was an important consideration for me. I have always been fairly comfortable with numbers. This was pre-Excel days when you had to work things on a calculator. And I felt I wanted a job which had a fair amount of numbers associated with it, which seemed finance. I also had trained as an engineer. And although I didn't do well in academics, I like the principles of engineering. So I thought, let's do something that combines engineering and finance. And from what I read, venture capital seemed an interesting area which combined the two. That was wrong. It didn't. But I got into the industry and it turned out I nonetheless liked it. I loved my colleagues. I enjoyed my job. I did it for pretty much all the 30 years I worked in the industry. So that's how I got in. So, it's hard for anyone else to follow my path because I stumbled into it. But there it is.
Fair. And how did you ended up in Singapore at that point in time?
I was with an employer whom I thought I'd stay with all my life, but things changed. And I felt to preserve my own integrity, I needed to leave. And the first job that came across was GIC. So I joined them, GIC. So this is my second employer. 8 years in the first, 22 years in the second, and that's my life.
That wraps up your life.
That wraps up, it does not wrap up my life. It only wraps up my
career.
Paid life.
Yeah, paid life. Okay. So just to provide everyone a little bit more context, in GIC, what did you do, and when do you retire, all that jazz?
So I joined GIC in 98 in their private equity business. I stayed with the same business for 22 years. I retired in 1990. So I started off making investments, and over time, I moved to doing strategy, risk, and even a bunch of HR-related things, which in fact I'm the most happy about.
Really?
Kind of stuff, yeah.
Okay. And then how has life been after living like a paid career? It's quite intense, yeah?
Yes, I think intense in a good way. It was a relatively low stress but high pressure from a professional perspective, and it was fun while it lasted. But I think, with many jobs, particularly these days, they take 120% out of you. And I reached the point where I wanted no one thing to take more than 20%. And unfortunately, my employer had no jobs which are part-time. So it was all or nothing, and I left.
That's good news for the people, right? You know that GIC is working the people at 120%.
Oh, yeah, absolutely. Yeah, no, can't deny that.
Okay. Yeah. And then you choose.
Yeah, retirement has been great. Yeah. So I planned it, actually. Maybe I planned it more than I needed to have. I started planning about 7 years before I quit. And I actually told my colleagues 3 years before I left, my boss and my CEO 2 years before I left. So they all knew I was leaving. And that allowed me to plan very, very intentionally. And in fact, my company helped me with some of my retirement plans by throwing things my way which they thought would suit me. So I planned to do a bunch of things. Some of them worked out better than expected. Some things worked out as expected. Many things worked out far worse than expected. But many other things turned up. So I would say the last 3.5 years have been the happiest years of my life. I mean, My GIC days were phenomenal, great. In fact, the last 5 years of my time in GIC were the best years in GIC. But the last 4 years, even better.
And that's why we wanted to get you in to set, right? To just kind of understand like how has life been like. And I also think a lot of the coverage of like retirement out there is not it's not indicative of where our audience is. You know, like a lot of middle upper class working professionals, you know, life has changed, it's different. So how does retirement kind of look like for someone, you know, of our listeners kind of, you know, parameter, right? Which I think you're still a little bit of a stretch. You're probably even more high performer. But we'll just kind of love to understand retirement from your personal anecdote so far.
For reasons which are obvious, the corporate world wants us all to believe that the only sensible way is to progress up a ladder, try your best to reach the top. And many of us have bought into it. I did too. And at one point, because I wasn't doing well in my career, I kind of figured out that why am I trying to go up? And I realized that, hey, you know what? There are so many ways to look at one's life besides just a corporate sort of progression. At the same time, the media, sorry, Reggie, is trying to tell us that we should buy more stuff, whether it's experiences or things, and therefore we need more money. So I think once you kind of break out of those shackles, you actually see there's so many other things happening in life around us. Now, don't get me wrong, I don't think money is wrong or it's not good to pursue money, but money is a tool. So as long as it's working for you, it's fine. It's like, you know, having a Ferrari in Singapore, right? I mean, the speed limit is 90. Most of the time it's crowded. So you can't use it. So if you have like $50 million, what are you going to do with it? So you figure out how much you need, and then you decide, okay, let's do other stuff. And then you try to put together a portfolio of all the things you want to do. And then suddenly you find out there's no time. And then you realize, okay, when I have enough money that I don't need to buy more stuff and I can't, then you say, okay, it's time to move on. And then let's gradually start bringing all these other things you planned into your life. Before you lose your health, before you lose your life, you do all the things you wanted to do rather than just the one thing. So work is great, but it's only one thing. And then you want to do 10 other things. You can do at least most of them if you give up work.
Yeah. So what made you come to such a realization? What prompted it?
People say failures are stepping stones to success. So my failure at work was wrong. Yeah. So I kind of figured out at one point that my colleagues were smarter than me, they were more hardworking than me, and they were more motivated than me. So they were going to go up faster than me. So either I can beat myself to death trying to keep up, or okay, I'm a different person, I cannot go up, so let's figure out other things to do. I think it was, it's like a punch in the gut when you realize that you're not good enough. But not good enough for going up the ladder doesn't mean not good enough to add value. So you figure out what can I do that makes my company still want to keep me, still make me valuable to them. At the same time, it frees me up from trying to go up the corporate ladder. So I think in 2003, when I really first realized that I wasn't going to go up anymore, or even if I went up, it was a much slower pace than my peers. It took me, I think, about 2 to 3 years to reconcile myself to that. But I think by 2007, I was very, very sure I was completely comfortable with my lack of progress. And that actually freed me up. It's one of the best things that happened in my life, not getting promoted when I didn't deserve to be promoted.
How was that reconciliation process like? Anecdotally, how did you feel and all that? What do you do?
So first, of course, when I first figured out that in 2004, my colleagues would probably get promoted and I wasn't going to get promoted, this is in 2003, anger, denial, all the usual stuff. And then
it's a package deal.
Yeah.
Everyone goes through the same thing.
And then I think gradually you kind of ask yourself, maybe first what's wrong with the company, and then maybe what's wrong with me, and then figure out nothing wrong with the company, nothing wrong with you. It's just that you're not cut out for the specific path that other people are following, which the company says is the right path, although there's no such thing. And then you figure out what is my path? What am I good for? And you realize that, you know what? Actually, I love being a dad. I love being a spouse. If I had more time and I had less distraction from work, I could actually be a better spouse and a better dad. So let's try that. And I think never looked back since then. Am I a good dad? Am I a good partner? I think you should ask my kids and my wife. But I'm a better dad. Maybe still falling short, but better than I used to be.
Nice. Okay. So with that revelation, and then you move into kind of planning what your retirement will look like, finding all the bits and pieces. How was that like for you?
I've always had many outside interests. I've always liked to read a range of things. I've always liked traveling to new places as well as to meet old friends. And there's a bunch of really stupid things I like as well. Like I like board games, I like jigsaw puzzles.
Catan.
Yeah, Catan
Yeah,
too. But
Catan.
yeah, although
Lovely.
that's not my favorite game.
Yeah, yeah.
But that's because my wife doesn't like it too much. But you can kind of indulge yourself doing all the things that you wanted to do. And I figured that retirement, however, means that you need to find things to occupy all your time, not just the extra few hours that be occupied by reading more or traveling more. Or playing more board games or jigsaw puzzles. So then you start thinking, okay, what are the things that I could do or would do if I had more time? And I guess because one, I started planning 7 years before, and two, because I could kind of be open with my colleagues and people around me that I was leaving, I was able to gradually build this portfolio of things to do when I retired. Yeah.
Nice. So you go into the pantry and say, I'm leaving, guys. I'm leaving. Don't give me more work. I'm going to
Yeah,
do other
something like
things.
that. Yeah, kind of. Yeah. Actually, some of my more senior colleagues were worried that I would zone out after I quit, which is why I thought long and hard before starting to tell people. But then I realized that, building a reputation is very difficult, losing it is very easy. And my colleagues, and to never think that I was shortchanging the company. So once I decided to leave, make it open to everyone, and at the same time reassure people that I will work 100% till my last day in the firm and demonstrate it. So, and I did tell my boss from the moment I retiring that anytime you want, if you think I'm not pulling my weight, just ask me to leave and I'll leave quietly. And I'm really, really pleased that when I actually was retiring, it was in the midst of COVID and he knew I like to travel. So he asked me, would I like to stay another year because I can't travel? But, by the time I knew that the momentum was there, if I stayed one more year, that year I would not have been able to pull my weight because we'd hired my successors, my work had been passed on. So I didn't continue.
Fair, fair. And from a small employer standpoint, like I don't run GIC,
Yeah.
but from a small employer standpoint, I think it's quite valuable to have that clarity that someone senior is prepping, his or her way out, right? So they're gonna leave and they tell you, okay, I have 6 months more. This is
Yeah.
how it is, Then sometimes I feel like the idea is always not tell anybody until like it's about to happen,
Yeah.
and then you drop a bomb on the company, right?
Yeah,
Essentially, or on your leaders or whoever, right? And then it's like, oh, I have a 2-month termination. It's like, what?
Yeah.
That's it? 2 months? I gotta find someone senior?
Yeah.
It's not very cool. So you better make sure you retire,
Yeah,
because
yeah,
the word
agreed.
will go out there.
Yes.
It's like it is person, man,
Yeah.
right? So I think it's very interesting that you let everybody know, and there's a nuanced take on this, right? Like how to kind of let everyone know that I'm leaving, and you still want to kind of keep the rap.
Yeah.
Yeah.
I think it's also important, and I was blessed to be in a company that's fairly forward-looking in terms of its people policies.
Oh, this is employer branding exercise, huh? GIC.
No, I left 4 years ago. I don't owe GIC
Yeah.
anything except amazing times.
Yeah,
And I had a fantastic boss. So and a good CEO. So when you put the three together, I was in circumstances which were exceptional. I think everybody should, think about leaving in the way I did. But if you have a terrible boss and you work in a firm with a bad, not a very good culture, it might not work for you. So I wouldn't say everybody has to do it this way. It might not be possible for you.
Okay. So coming on to the whole idea that, okay, you then pick up the pieces of what you like, what you're interested in, how to occupy your time on that front. Is it just all about what you like and what you enjoy? Like, or like, do you add other things? Like, how do you kind of frame this parameter? Because the goal then determine the plan, right? So like, how do you decide, like, how am I going to do retirement?
One philosophy I've tried to kind of live my life by is you can do what you like, you can do what you love, or you can love what you do. Life is much simpler if you just love what you do. So suck it up. These are the circumstances, these are the cards that life has dealt. Play them as well as you can. So I like to think I've picked up a bunch of things that I like doing and then I continue them. But it's also a bit of, sometimes something just comes which is maybe not great and I try it and I say, okay, if you could repeat it after a while, you like it. So I stumbled into teaching post-retirement. I find that's absolutely brilliant. I love it. As I said, read a lot more than I used to, and I find interesting to read a lot. I spend a lot of time hanging out with people, one-on-one, in small groups. It started off very interestingly, and I talked to people about retirement who had retired quite a lot before I did, just to make sure that I was doing the right thing, how to go about it, what are the mistakes they made, what can they tell me. And one of the things was that many people found it hard to relate back to their partners and get back to spending time with their partners. I even know a couple of people who, divorced after very soon after they retired. And one of them, when I asked him what happened 30 over years after being married, he said, being apart kept us together. So my wife and I think we decided that every day for half a day, Monday to Friday, I would get out of the house if she was not getting out for some reason and stay out of her way for at least until lunchtime. And that would help us adjust back to each other. And what do I do at that time? Meet people. So I'd have lunches, coffees with people I knew from work, mostly either people who were in GIC, who had left GIC, counterparties I'd used to meet. And I think I just enjoyed doing it. And yeah, people were talking to me. The conversations were rich. I learned an enormous amount. People don't seem to stop wanting to meet me. So that's
great. It's a good
that's
sign.
great.
Good sign.
So that's how I started meeting people. And now I actually get out, even now, 4 years later, 2 or 3 times a week when I'm meeting you for a couple of hours now. I'm meeting an ex-colleague for lunch after this. And I did that yesterday. I'm doing that tomorrow also.
Yeah.
So yeah, that's how I pass my time. These are probably 3 things that occupy the most of my time. Yes, the fourth one is kind of taking care of my body as well. So I'm not very athletic, as you can probably see. So I walk a lot, play a bit of badminton with my wife, go to the gym once in a while. So I would say 2 hours a day of reading, 2 hours a day of meeting, 3 hours a day of maybe meeting people on average, 2 hours a day of reading. Yeah, and then teaching. Even when I'm not teaching, I maybe spend 1 to 2 hours planning my teaching. These are the sort of the big chunks of my time. And then there's travel, there's
all
a
those
bunch
stuff.
of other things. Yeah.
Nice. But when you were planning your retirement, right? Like it probably wasn't this clear, right? Because you're essentially modeling 10 years out.
Yeah.
Like what was it at a point in time? How does it differ to where it is today? Yeah.
So two of the people actually who I spoke to about retirement, they told me 2 things, a few things actually. One is, if in 2 years after you retire, if you're intentional about your retirement, you'll find yourself actually overcommitted with too many things. So do only the things that you are keen to try out, at least, even if you don't want to do it in the long term. And only do things with people you really enjoy hanging out with, because otherwise, what's the point? So I would say those were really the rules I used. But it's not that difficult. Just to give you an idea of the things I thought originally, teaching was something I wasn't planning to do, but in the last 2 months before I retired, my ex-employer, GIC, the head of training, and I'd been helping her with some stuff, offered to introduce me to one of the local universities and say, hey, would you like teaching, since you seem to enjoy training and doing some teaching work within the firm? So I said, yeah. And that started 6 months after I quit. It wasn't planning. And now I'd say it takes up about 30, maybe even more, 30% of my time in the course of the year. So you plan out lots of things. I was hoping that the momentum would carry me forward for at least a year or 2 when more things came in and some things fell out. And that's the way it panned out. Half the things didn't work out, but lots of new things came on board.
Okay. So in essence, it's still very iterative, right?
It's very iterative.
Okay. Yeah. But then from a planning, from a financial standpoint, right? Because I think that's what a lot of people think about. Okay, they try to model what retirement will look like, they attach a price tag to everything, and then they kind of work backwards on the plan, right? Like, how did that play out for you? Did you use the method? How do you do from a financial kind of situation? I mean, GIC probably paid quite well.
I think this is the hardest part, because when I'm talking in a forum like this, what I say may not have much relevance. I think those of us who work in the financial services sector are very well paid. In the private equity industry, in the investment management industry, we're even better paid. I'm not even so sure if the salaries are justified, although people who are listening to this might disagree. So I didn't have to have many deep thoughts about how I'm going to finance my retirement. I mean, it wasn't always like this. I was struggling to make ends meet for the first half of my career, and things got gradually comfortable only in the second half. So it's not that I ever thought I would retire in comfort. I think I was planning to retire in my early to mid 50s, right through my working life. So the timing was not changed. I was planning to seriously downsize, right size in retirement.
So positive,
that I didn't,
right size.
that I didn't have to is a blessing. So, in a sense, my comfortable retirement is a bug. It's not a feature. The feature was I must retire. I must retire not later than 55. And I'll figure out how to make it happen. By pure chance, it happened to be very comfortable.
So contextualizing it for the people then, right? Like, okay, so for you, it may not be that, planned out because probably, quite made some good money and a lot of people in finance, they do that, right? So, but for everyone else, from your viewpoint, how should it then be done?
So I would say that I would actually kind of say
Rephrase
I
it?
did, yeah, I did plan it. I planned it from the time when I earned very little money. So the planning for retirement started early. It's just that I could take my foot off the accelerator because after a while, finances became comfortable.
Yeah.
So I think I still have something to say. It's just that I didn't have to follow those rules in the last 5-6 years.
Fair.
But I think most important thing, frankly, is starting early. I mean, I have a daughter. I have two daughters, and my older daughter started saving money from her first paycheck and started giving money from her first paycheck. And frankly, it's one of the things I'm happiest about in my sort of the things I've achieved as a parent.
Why?
Because I think starting early is the most important thing, both for planning for your, in a sense, body, which is saving, and planning for your soul, which is giving. And I think once you start early, it becomes so ingrained that it's almost certain that if you, and almost, it's not absolutely, but in a place like Singapore, if you have a sort of a job that's halfway decent, earning kind of median income, if you start with your saving however little with your first paycheck, you should be able to retire in your mid-50s, I think. If not by 62, 63, or 65, whenever the government allows you to. But it should be comfortable. Likewise, if you start giving from your first paycheck, by the time you reach old age, I think you can probably, the government can actually take its foot off the pedal in terms of welfare because we are taking care of the community ourselves, which is the way it should be.
Okay. So when you were planning at that stage before all the good waves came in, right? Like what was the plan? How do you kind of formulate that?
It's almost a no-brainer. Most of us know it, we just don't do it, which is saving money right from the start. For two things. One is the earlier you start, the more you compound. The even more important thing is we all make mistakes. It's better to make mistakes in your 20s when you have very little money and losing everything means you lost only 6 months of earning power.
You can just kind of work it back.
Work it back. Whereas if you start saving in your mid-30s, you're already trying to make up for 15 years of lost time. And then you lose it, you're much more kind of kiasu, whereas you can be more risk. You can make all your mistakes in the first several years. And then, not that I never made mistakes after that. I made tons of mistakes, including mistakes in the last 3 years. But you make fewer mistakes, at least. Half the mistakes you made in your
You already make younger, right? So you right size the risk, it's easier.
So I think the most important things are starting early because you can compound and because you can make the mistakes early in life.
Yeah. Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. How do you reconcile this idea that, okay, you want to, because what is the train of thought out there is let's model your way of life in retirement and then work backwards on what it is, right? But the first half of the discussion was how iterative your retirement was, right? And or is, right? And this part, we sort of talk a little bit about like the plan, right? Like, so does it mean that you really just work on first principles and you don't really kind of work towards a plan or a goal in mind? You know what I mean?
Yeah, I think when I told my first boss that I was retiring about 3-4 years before I actually left, he told me that in 1992, in my second performance review, I had told him that I wanted to retire in my 40s, which I didn't make it. But so I think I've been thinking of retiring early from my 20s. But it was a very forward-thinking plan rather than a plan that was concrete in the early years. So it is more, I must save so that I can retire rather than this is my number.
Yeah.
Because you can't even, in your 20s, you can't even conceive what the number is. And in fact, you'll be so horribly wrong.
Yeah. Who dares to model 30 years?
Yeah. So it is more a question of I should be saving, I should be not overspending right from my first salary rather than how much should I save. I think until my mid-40s, I wasn't actually modeling my retirement numbers. I think late 30s is a better time to start than when I started. I think by the time things are falling in place, because for instance, If you're planning to have kids, your kids were probably
Yeah, by then, yeah,
there,
more or less,
or
yeah.
more or less there.
Yeah.
At least you know there's not going to be more than one more or two more. Your career, you kind of know, are you going to be CEO, or are you just going to be a guy who's plodding like me, and therefore it can help you plan your retirement? By then, hopefully, your spending patterns have also fallen in place, and you kind of know what will make you happy in retirement.
Yeah.
Probably in your late 30s is when, so I would say in my mid 20s to mid 40s, it was more of let's just get on with it rather than how much are we planning for. It was more a time. And I still think time is important, as in setting a stage and saying, I want to retire at so and so age makes it very concrete
Yeah.
rather than when I get so much.
Yeah.
Because when you get so much, you think, wow, I need some more.
Yeah, yeah, yeah.
So if you say, I'm going to retire at 54, which
This
is what
is
I
the
said,
line,
this is the
yes.
line.
Yeah.
And whatever I do, I have to do by that time. Of course, if the catastrophic things happen, then you may have to change.
Yeah.
But at least you're working towards a target. So I would say from 45 to 54, I was working, or 45 to 50, I was working to the target. By 51, I think I had reached the number, or rather, I'd reached a stage where I thought with right sizing, I would be comfortable. And 50 to 54 was when my financial position really strengthened, which is why I could finally retire without
Even right sizing, right? Okay, okay. Nice. I like that context, right? So if let's say we work on the situation of like right sizing, right? Together with whatever you've accumulated, not the last few like windfall years, right?
Yeah.
So let's just assume we work with right, because I think that's where a lot of Singaporean professionals are kind of at, right? Like you accumulate and then you right size and then you kind of cruise through from there, right? So from that as the basis, what were your plans then? From like maybe your portfolio perspective, all that jazz, because likelihood, the idea is you're not going to make an active income. Let's try to like get a portfolio going with the financial markets and then go from there, right? So what was your planning process from the portfolio perspective?
I think like most people, even though some of us don't like to admit it, I'm not a very good stock picker. I'd say at best, I'm average. The stocks that have done well as much through luck as through good skills. So
Coming from you,
coming
really?
from me, yes. I was not in equities. I was in private equity. So
okay.
I can boldly say that had I been in equities, GIC wouldn't be doing as well as they've done. I have very, very smart colleagues in equities. But I think I kind of did index-ish investing, I'd say, because index funds didn't come till quite a few years after I started working. So I would kind of try to find themes and invest in multiple companies in those themes to kind of I wasn't thinking explicitly of modeling indices, but I'd say things like, oh yeah, I think healthcare is fine. Let's invest in several companies in healthcare, or banking, which are two industries, financial services in India, which I invested in, or IT services as well. In my early years in Singapore, and even towards the end, I also tried to max out things like CPF, SRS, which we're privileged to live in a country where we can get kind of risk-free returns, which are pretty decent. In a country which has most of the time had 1 or 2% inflation, you get 2.5% to 4%, 5-6% for certain parts of your special account. I think they're all no-brainers. So you try to max out what you can get with low risk,
with
or
certainty,
just
right?
keeping with the market, rather than trying to be very smart. If you think you're very smart, take 10%, 20% of your portfolio and play with it, but keep 80% of it for your retirement and 20% it for entertainment. So I do that too. When my personal portfolio now, because I was from the private equity industry, is very heavy into private equity. I have many friends who started their own private equity funds, other counterparties, and I can invest in those. I couldn't do it when I was in GIC, of course. But now I'd say my portfolio looks unlike what many others' portfolio looks like. What I'd say is you need to understand yourself. Perhaps the most important thing in portfolio in investing is to maintain the course. I mean, the average person, and I'm average, buys when things are high and sells when things are low. So the sensible thing is to try to protect your portfolio from yourself, which is really doing a systematic investment plan every month, buy $100 or $1,000 worth of stock, buy when the market is low, buy when the market is high. Don't try to time it, don't try to do anything. So the most boring and the most stupid things are probably the most sensible things if you're looking at a 40-year time span, which is what we should be. when we start investing.
Nice. So you will double down and echo on that point. You will agree on this, right? Because this
Yeah,
what is
100%. Yeah.
okay.
I
Okay.
mean, there's a reason why people say that's the right thing and why they say it so often, because it's true, but people don't follow it. Not even the people who say it.
Really?
Probably.
Nah. Okay. Nice. So from that view, essentially, broad-based ETFs, index funds,
I think so.
DCA.
Yeah.
That's the best bet for
Yeah.
most average professionals.
Yes, I would think so.
Okay.
Yeah.
Okay. And for people that are smarter, thinking that they can, beat the market, do you have any other things you want to tell them?
I think, broadly, whatever you invest in, try to understand it. So, for instance, if crypto is your thing, understand it deeply. And if you do, then, and if you're willing to take a bet on it, spend I would say, up to 20% of your portfolio taking the bets that make you happy taking after studying them well. Maybe you could make money. I mean, I know people who tell me they made a lot of money in things like Nvidia, Tesla, crypto, and good for them. But for every person who's made money like that, there might be 10 people who have not made money and who aren't talking about it, who are ashamed of it. So, if you're driven by those people who have said they made money and don't hear of the 9 people who didn't, that's incomplete data you're relying on.
Yeah.
So it's fine to take those calls, but take them with your eyes open after having done your research and not before.
Fair. I like that. What about the whole balanced portfolio, 80-20 stocks, bonds type of situation? Do you have anything to say for that? Because the base assumption is you try to moderate volatility, right?
Yeah.
With something that's a bit, with bonds, right? But inherently bonds are not less risky, right? It really depends on what you're doing with that. So how do you reconcile this? Do you think a balanced portfolio works, or do you think it's just like, okay, let's just go with index funds, broad base, stocks outrun, over a long course period of time? Like, where do you stand on that?
So volatility should be, and the thing is, I come from the private equity industry. So for me, volatility is irrelevant. What matters is only how much you buy it at and how much you sell it at. What it does in the middle is just distraction, which is why, if you keep on buying and holding and buying and holding and buying and holding, the volatility is irrelevant. In fact, I would argue that you should not look at your prices every day. And I was recently, for the first time, somebody asked me to be on their board. It surprised me no end. But one of the things I realized was that they report their performance too often, of their investment portfolio. Because then every time something goes down, you think, wow, what went wrong?
Yeah.
And after nothing, it's just the market went wrong, not your investments. So if you don't look at the papers and don't look at the prices and just keep on buying broad-based stuff, the volatility is irrelevant. And if you're investing anything over 20 years, I think stocks will outdo bonds. So in your 20s and 30s, I would say 100% in stocks or ETFs or broad-based stocks if you don't want to do ETFs. And just hold and hold and hold and hold. In 20 years' time, you'll be fine. Or 40 years' time, you'll absolutely surely be fine. Of course, if you're in your 50s and 60s, do you want a portfolio of stocks? Because, if you're thinking of 20 years to be guaranteed of success, you might not be alive or be able to enjoy the money. Maybe put some of it in bonds. And but again, you need to be pretty careful that maybe the thing is to put it in something like a CPF if you could. Unfortunately, I suppose after a certain age, it's harder and harder to top up stuff.
Yeah. Fair. Okay. I like that. So maybe I'll just push you a little bit on that, right? Because a lot of these models are built on the strength of the US dollar, right? So a lot of them are tied to the US dollar, whether it's a P market and all that stuff. But it looks like we are in the cusp of global change, right? You see all these things that are happening. Do you have any take on where the US dollar will go? Like if it continues to depress from a steady point of view, I think we can model that quite accurately, right? It's not that difficult. But I think the fear now is, what if it totally no longer relevant, right? Similar to the pound, phasing out. Like, what do you have to say to that?
Nothing. I don't understand currencies, never understood currencies. If I try to predict, I'd be guessing. I won't even try.
Yeah, fair.
I think, frankly, economists, half the economists and analysts get things right, and half of them get it wrong. And we have no idea which half is right and which half is wrong.
Fair.
With people like me, I mean, forget it. I'm not an expert.
Fair. So then you will not model that risk in your investment portfolio.
Yeah. So to answer that specific question, because I don't understand currencies, I think in two currencies and two currencies only, which is US dollar and Sing dollar. I would love to think 100% Sing dollar because that's my home currency. It's just that the market is quite not very deep.
Mm.
So
There's not a lot of things to buy,
yeah.
right? Yeah.
So I do think in Sing dollars. At the same time, the bulk of my investments are in US dollars.
Mm.
I don't hedge. I don't know how to hedge in a way that would make sense for me financially. So I just take the risk long.
Okay,
If the
fair.
US dollar collapses, then so be it. So will my portfolio.
Yeah. Fair. Thanks for that clarity and the
Yeah.
candor, right? Okay. So maybe I just want to take some time to touch into your wheelhouse, right? Which is like private equity, because it's getting trendy, right? With all these marketplace platforms that are essentially building access for more and more working professionals. You don't need to be a accredited investor anymore. There are all these platforms that you can buy all these like weird early stage companies. You know, like, and that is your space, right? All these new age companies. Are there certain rule of thumb that you want to just let the people know? Like, if you're entering this thing, how you should think about it? Yeah.
I think the good thing about public markets, stocks, is that most information is available to most people within a reasonable time frame. So of course, professional investors have more information quicker, but you can play against professionals, particularly if you have a long time frame, and still make decent money. I don't think that's the case in private markets. It is as unlevel, as unfair a playing field as you can think of. Imagine the worst playing field. It's a lot worse than that. Good opportunities only come to people who have access and often who already have too much money. If you're outside that sort of group, more likely than not, you will see the opportunities that nobody else wants to put money in. This doesn't mean to say that you can't make money. People can be quite stupid, right? Even including smart investors. So people might be missing opportunities that you can perceive. But those are all, outliers. Or your best friend might be the person who was Mark Zuckerberg 20 years ago.
Genius in your dorm room.
So you get those opportunities in the ground floor. But more often than not, it's not going to happen. So if investing in early stage and startups excites you, set aside a small portion of your portfolio. I would say 5% is great, but if you really must, 10, 15% max. And study that market. Get yourself plugged into startup founder groups, angel investor groups, and then either follow people, which might not work, or use your own judgment. But make sure you're playing with relatively small amounts of money, which don't really matter. After all, if one of those investments does well, you're going to make 100 times your money.
That's the game, right? Essentially. Yeah.
So if you lose your money, you're going to lose small amounts. So on balance, I would say it's fun, but it might not be profitable. Again, I could be wrong. Just be aware that a lot of people don't make money out of it.
Yeah. I mean, you did say it's like investment and entertainment, right?
Yeah,
So this is like
this is entertainment.
kind of entertainment.
Yeah.
Okay. But if let's say just maybe one last thing to share, right? So if someone decides, I mean, I get what you're saying, right? Like, okay, you allocate a small amount of money, you go around, get to know the people, because that's the game, right?
Yeah.
There are tons of activities, VC, angel circles, founder, demo days, everything, right?
Yeah.
You got to go for all that. Don't go to marketplace and expect to read something and buy that. It's not going to work, right? Yeah. That's the shittiest things end up there, right? So you got to go deep into the tranches, right? So if let's say someone decide that they will go deep into the tranches, after work, they are a lawyer, very tired, but they still go for all these activity, 2 or 3 times a week, just kind of get connected.
Yeah.
What are some parameters that to you will increase their chances when making these kind of investments?
I think be very skeptical about people. And if the person running the company or the team running the company, you have even the slightest doubts, I would say usually stay away. People go wrong much more often than other things go wrong in a startup. Teams falling apart, founders going rogue. So more than anything else, it's the team. But again, it's also about how you are or the person you are. So in startups, I like to think that there are 3 ways of investing. And, I'm not an expert. So lots of people listening to this might say, this guy's talking crap. And I might be. Most of the time I do, I think.
But you're ex-head of private equity.
No,
so you must have some basis.
I was not ex-head of private equity. I was head of private equity risk in GIC. But then, we all have titles up.
Yeah.
Don't take it too seriously. So think of a Formula One race. You can either have the best car, you can have the best driver, or you can drive in a track that suits, that track that's fast. So you can either invest in a company with an incredible management team, or you can invest in a company that's got an incredible product, or you can have be in a market that's expanding or exploding. More than one of these is rare, but could be. But essentially, you as an investor have got to understand whether you're good at judging people, finding the best management team, the best driver. You're a person who's good at assessing good products in a market. So are you the person who can figure out, this is the best car for the race today? Or are you the person who can say, this is an incredible market, I want to play in that market, and I will invest in 3 companies in that market because I don't know who's going to win, which is you pick the best track. So perhaps I am saying that it's good, picking management is important because I think I'm a person who can assess people, whereas somebody else might be good at assessing products. So what I'm saying is because of who I am, not because that's the best way or the only way. So you have asked a very simple question: how do you assess a startup? So it's first, who am I? What can I do well? Or can I do anything well? If you can't do any of these things well, stay out of it.
Yeah, fair. It's true. It's really about like information advantage, right? Like how much do you know, right? And I have friends who are like, senior engineers. They really know their stuff in whatever engineering field that they're in. So they just acquire all these engineering companies, private, listed, whatever, right? Because they know, like, I know those people. I know what's going on. I know what's being developed, and they have unfair advantage in the space that they're in, right? So
it is about having unfair advantage. What is your unfair advantage? Can you find an unfair advantage to exploit?
Nice. I like it. Okay. So maybe just one last question to wrap it up, right? So for people that are, thinking about retirement, and you have thought about it, planned it, and executed it, and iterating it, right? What are some things that you think? Because in the beginning you did say like, I planned all this and totally flopped, right? Like, so what are some of these things that people should kind of think about, based on your experiences? Because to be fair, you really shared a lot and in a very structured way. So I like it. I just want to see I can get any last few things out of you.
See, the reason why it's hard for me to say something very generic like that is because we are each individuals, right? For someone else, shooting to be the CEO of your company is the best thing to do because you have the capacity. For somebody else, never retiring is a good thing because your work gives you so much joy and you have so few other interests. So maybe at one level you should build other interests, but at another level maybe it's not worth it because your work gives you so much joy. So maybe the first thing is just understand yourself. Don't jump into retirement. I actually know people who retired and then unretired because they found retirement so boring. One of my friends told me that his wife was just sending him out to do errands all the time. So he didn't want to. He stopped being retired and went back to doing a job, and quite a stressful job too, I think. Although he enjoys it.
But he enjoys it.
Yeah. Okay. So it's not about what advice can I give you. Yeah, understand yourself first.
How would you go about understanding yourself?
What do you do day-to-day basis that you enjoy a lot? What do you wish you could do more of? Maybe you should try that on weekends and see if that really gives you, or is it just an ideal that when you actually do it, you don't find so fun? Look, I'm just making it up as I go along, man. You're asking me questions which, honestly, I don't have a good answer to,
Nice.
You go figure out for yourself.
Like,
I did it by introspecting for many years, deeply for 7 years, and I think at the surface for 25 years.
Yeah, I mean,
so
since your first job.
Yeah.
Right?
So I think we have one life. We owe it to ourselves to live it well. Nobody else owes us a good life. We plan education well. I mean, parents plan their entire kids' lives almost when they're very young in diapers, saying, I want them to go to this enrichment class, learn swimming, then learn riding maybe, and then learn the piano, and then go to school, do this tuition, this enrichment, go to college, go to this university, find a job, find a partner. We plan things so much. Why don't we plan retirement with the same rigor, right? After all, we're living longer and longer lives. There's more and more years to enjoy or regret after you finished your last full-time job. I think it requires an enormous amount of investment in time and introspection, and it's totally worth it. Nobody else is going to try to give you a good retirement except you.
Nice. Thank you. That's great. That's great. I love it.
Okay, thank you. This is fun too.
Thank you for your time. Lovely.
Yeah.
And if, let's say, our listeners want to connect with you, is there like a place they could kind of email you?
Yeah, of course.
Or like, would you like to just share where's best to connect?
Yeah, it's very easy to remember. It's mail, M-A-I-L, at ashoksamuel.com.
Nice. We'll drop it in the link below.
Yep,
So yeah,
absolutely. Do
thank
that.
you for your time. Awesome, awesome. And
It was
that's
good
a
fun. Yeah.
wrap. That's a wrap.